Ladies and gentlemen, today I want to pull back the curtain on a story that most in the mainstream media aren't even whispering about. JPMorgan's silver vault, yes, the very vault that has long symbolized stability in the precious metals market, has just hit a crisis level, and the implications are staggering. Imagine a $8 billion exit from silver positions, something nobody saw coming, something that could ripple through markets faster than lightning. Now, why does this matter to you? To me, to anyone who even casually follows the financial world. Because what happens in these vaults, these titanic reserves of wealth, doesn't stay in the vaults. It touches the price of silver, the confidence of investors, the very fabric of global finance. And here's the hook: this isn't just another numbers game. This is a warning, a rare signal that the times are changing, that the forces of supply and demand, of institutional strategy and human psychology, are converging in ways that could redefine wealth in the coming months. Consider this: JPMorgan's move wasn't just a reaction, it was a declaration. It reveals cracks that most have overlooked, and it asks a question we all must confront. Are we prepared for the seismic shifts, quietly shaking the foundation of the markets? Think about the lessons here: vigilance, timing, and insight are not optional in finance, they are essential. And it's in moments like these that the sharpest minds see opportunity where others see panic. When a $8 billion exit shocks the system, the doors to understanding, to positioning, to strategic advantage swing wide open for those who are ready to notice, to learn, and to act. 1. JPMorgan's silver vault crisis. JPMorgan's massive silver reserves have reached a critical stress point. A sudden $8 billion exit signals an unprecedented shift in institutional positioning, highlighting vulnerabilities in what was assumed to be a stable part of the precious metals market. This is a major indicator for investors to reassess market confidence. 2. Impact on global silver prices. A vault-level exit of this magnitude directly affects silver liquidity and market pricing. Such a move can create price volatility, leading to ripple effects across commodities, ETFs, and futures markets. Traders and investors must understand that these shifts are not isolated, they reflect global financial interconnections. 3. Hidden signals in institutional moves. When a major bank like JPMorgan adjusts its holdings dramatically, it sends a subtle but powerful signal to the market. Observers who detect these moves early can position themselves strategically, demonstrating the importance of analyzing institutional behavior for predictive market insights. 4. Market psychology and investor confidence. Beyond supply and demand, this event underscores the role of psychology in markets. A sudden liquidity move by a trusted institution can trigger fear, uncertainty, and overreactions among investors. Recognizing the psychology behind market movements is critical for managing risk and opportunity. 5. Opportunity in crisis. While $8 billion exiting silver seems alarming, crises often create opportunity. For informed investors, understanding the factors behind such moves, hedging, liquidity needs, or speculative strategy can reveal potential gains for those who act with insight and timing. 6. Broader implications for financial strategy. This vault crisis highlights the importance of portfolio diversification, risk management, and foresight. Investors and financial strategists must pay attention not only to market trends, but also to the hidden structural signals of large institutions, as these often precede broader economic shifts. JPMorgan's silver vault has long been seen as a fortress of stability, a silent pillar underpinning confidence in the precious metals market. But now, that perception is being tested in ways few anticipated. When a $8 billion exit occurs from a single institution's silver holdings, it is not merely a transaction, it is a seismic signal that resonates across markets. Imagine walking past a dam, feeling its weight, assuming it is unyielding, and then suddenly noticing cracks forming along its structure. That is exactly what is happening here. This is not a whisper. This is a loud alarm bell for anyone who has relied on assumptions about market stability. It begs the question: what hidden pressures drove this decision, and what does it reveal about the invisible currents shaping global finance? Investors often focus on headlines, but the true story is in the vaults, in the unseen flows of capital, in the strategic moves that most miss until it's too late. JPMorgan's exit forces us to reconsider what safe really means in a world where billions can move with a single decision, altering liquidity, pricing, and sentiment. The hook here is clear: while many may panic, the opportunity lies in perception. Those who recognize the significance of a $8 billion shift before the masses react are the ones who can leverage foresight into advantage. It is a call to vigilance, a challenge to sharpen analytical instincts, and an invitation to see the story behind the numbers. This vault is more than a storage facility. It is a lens through which we can read the health of financial markets, the priorities of institutions, and the hidden fragility that lurks beneath apparent stability. The event exposes a rare glimpse of market mechanics that few outside institutional circles ever witness, a sudden pivot that can unsettle pricing structures, trigger speculative behavior, and test confidence at multiple levels. Understanding this move is not about fear, but about insight. The magnitude of this exit compels us to ask, if a single vault can shift the equilibrium, how prepared are investors, analysts, and strategists to interpret and respond to these hidden tectonic shifts? The answer to that question could define who thrives and who merely survives in the rapidly evolving landscape of global finance, where silver is not just a commodity, but a signal of institutional behavior and economic foresight. A sudden, massive exit from JPMorgan's silver vault doesn't just affect one bank or one portfolio. It has the potential to reverberate across the entire silver market, shifting prices in ways that few anticipate. The four died. 8 billion movement may seem abstract when you hear it in numbers, but in practical terms, it alters the delicate balance of supply and demand that determines market stability. Every ounce of silver withdrawn, every contract closed, every strategic repositioning sends ripples that impact traders, ETFs, futures markets, and even individual investors who are far removed from the vault itself. The hook is undeniable. Silver is more than a commodity, it is a barometer of financial confidence. When a titan like JPMorgan adjusts its holdings dramatically, the market reacts not always instantly, but inevitably. Price volatility is no longer hypothetical, it becomes a lived reality. The psychological effect on investors can be just as powerful as the physical movement of the metal itself. Panic, hesitation, overreaction. All these human responses amplify the impact, creating a feedback loop where perception and reality collide. This is where opportunity and danger coexist, separated only by foresight and preparation. Those who recognize the signals early can position themselves to benefit, while those who rely solely on conventional wisdom may find themselves reacting too late. It's also a lesson in interconnectivity. Global markets do not operate in isolation. A single decision in New York can ripple to Hong Kong, London, and Zurich within hours, affecting traders who have never touched a silver bar, but whose portfolios are intertwined with these shifts. The four died. 8 billion exit is a wake, up call to look beyond headlines and listen to the undercurrents, understand the flows of capital, monitor institutional behavior, and anticipate the consequences before they fully unfold. In times like these, volatility is not a threat, it is a signal. A signal to pay attention, to analyze, to act with strategy rather than emotion. The market whispers secrets to those who are alert, and in the case of silver, these whispers have grown into a roar, demanding focus and strategic thinking. Understanding the impact of such a monumental movement is not just about observing numbers, it is about reading the story they tell about liquidity, investor behavior, and the hidden pressures shaping global commodities. When JPMorgan executes a 8 billion exit from its silver vault, the consequences ripple far beyond the walls of the institution itself. This is not a routine shift in holdings. This is a tectonic adjustment that redefines market dynamics in real time. Silver prices are intimately tied to liquidity, supply, and confidence, and such a monumental move can instantly unsettle all three. The first hook lies in the realization that every ounce moved, every contract closed, sends signals across the global financial ecosystem. Traders respond, ETFs recalibrate, futures contracts adjust, and what may appear as a single institutional decision can set off a chain reaction affecting thousands of investors worldwide. Price swings in silver do not occur in a vacuum. They are magnified by perception, and perception is fueled by action. When a trusted financial institution like JPMorgan makes a decisive exit, it is interpreted as information, a statement about market conditions that can drive fear, caution, or opportunism. Understanding this dynamic is crucial, because in commodities, timing and insight are everything. The second hook is the interplay between tangible assets and market psychology. While physical silver remains finite, the market's reaction is governed as much by human behavior as by supply. Investors watching this move may overreact, amplify volatility, or misread the underlying strategy, creating opportunities for those who maintain clarity and discipline. The third hook is in the subtle, but profound lesson about interconnected markets. A move in a single vault in New York reverberates through Hong Kong, London, and Zurich, impacting global pricing and liquidity instantly. What seems like a localized event becomes a global conversation, one that can determine portfolio performance across continents. It forces every market participant to pay attention, to analyze data beyond headlines, to read between the lines of institutional maneuvers. A 4.8 billion exit is more than a transaction. It is a signal of shifting priorities, emerging pressures, and potential imbalances. Those who ignore it risk being swept up in volatility, while those who anticipate its implications gain a rare vantage point in understanding both the mechanics and the psychology of the silver market. In this moment, silver is not just a commodity, it is a lens through which we can interpret the hidden currents of global finance, the strategies of institutions, and the movements that shape opportunity for those prepared to see it. When a financial titan like JPMorgan makes a sudden, massive adjustment in its silver holdings, it is not just a transaction, it is a message encoded in capital. Institutional moves of this scale carry hidden signals that few outside the inner circle truly understand, but those who can decode them gain an extraordinary advantage. The first hook lies in recognizing that the market is a conversation, and every move by a major player is a sentence, a warning, a clue. A 4.8 billion exit from silver positions is not random, it reflects strategic calculations, risk assessments, and anticipation of future events. To the untrained eye, it may appear as mere market noise, yet to the vigilant observer, it is a signal flashing in bright lights. The second hook is that these institutional maneuvers often precede shifts in price and liquidity. When JPMorgan reduces its exposure, other market participants, ranging from hedge funds to retail investors, react, creating momentum that amplifies the initial move. Understanding these signals allows those prepared to position themselves strategically, not reactively, transforming a seemingly chaotic event into an opportunity for insight and advantage. This is where foresight becomes currency and knowledge becomes power. The third hook is the subtle interplay between transparency and opacity in financial markets. While public data only reveals part of the picture, the true story is hidden in the flows of capital, the timing of trades, and the accumulation or liquidation of positions. For those willing to study patterns, historical behavior, and institutional tendencies, these moves are a roadmap to understanding broader market trends before they materialize. This is not speculation. It is the disciplined observation of signals where intuition meets analysis. Every exit, every adjustment, every portfolio realignment is a breadcrumb leading to the next potential shift. By interpreting these signals correctly, an investor or strategist can anticipate changes in liquidity, price pressure, and market sentiment before the majority even recognize the movement. The market rewards those who see beyond the obvious and act with precision. JPMorgan's 4.8 billion exit from silver is more than an isolated event. It is a lesson in the power of observation, the value of insight, and the importance of understanding institutional behavior. It challenges all of us to sharpen our analytical skills, to read the market between the lines, and to recognize that the most powerful signals often come not in headlines, but in the silent, deliberate actions of the largest players. Beyond the numbers, beyond the contracts and vaults, lies the most unpredictable force in any market, human psychology. JPMorgan's sudden 4.8 billion exit from its silver holdings is not only a financial maneuver, it is a psychological jolt, a signal that tests investor confidence and market sentiment. The first hook is this: markets are as much about perception as they are about reality. When a trusted institution takes decisive action, even the most experienced investors pause, question, and reassess. Fear and uncertainty can ripple through trading floors and online forums alike, amplifying price volatility in ways that physical movements of silver alone cannot explain. The second hook comes from understanding the power of anticipation. Investors constantly scan for patterns, signals, and potential disruptions, but a move of this magnitude disrupts expectations, forcing participants to confront the unexpected. How do you respond when a 4.8 billion shift occurs seemingly out of nowhere? Panic leads to reaction, insight leads to opportunity. Those who recognize the psychological triggers embedded in such actions can navigate volatility with clarity rather than being swept up in it. The third hook is the interplay between herd behavior and market signals. When institutional giants adjust positions, many market participants follow instinctively, creating feedback loops that magnify the initial impact. This is where understanding psychology becomes a strategic advantage. Recognizing when fear drives the market versus when fundamentals drive it can be the difference between loss and gain, between hesitation and action. The fourth hook is in preparation and discipline. Emotional responses to market shocks are natural, but disciplined investors use these moments to analyze, strategize, and anticipate the broader implications. A 8 billion exit is not merely a reflection of current conditions, it hints at potential pressures, liquidity issues, or strategic shifts that may unfold in the days and weeks ahead. Understanding the psychology behind market reactions allows one to interpret these moves not as threats, but as signals that reveal confidence levels, risk tolerance, and behavioral tendencies of investors across the globe. The Vault's crisis is, in essence, a mirror reflecting how fear, caution, and expectation shape financial markets. For those who learn to read it, the human element of markets becomes a tool, not a trap, a guide to navigating volatility with foresight, insight, and strategic precision. While a 8 billion exit from JPMorgan's Silver Vault might initially spark concern, savvy investors know that crises often create some of the greatest opportunities. The first hook is this: what appears as turmoil to the unprepared is often a signal to those who are alert, ready to act, and willing to look beyond short-term noise. Market disruptions expose imbalances, reveal hidden pressures, and open windows for strategic positioning. In the world of precious metals, timing is everything, and understanding the reasons behind a massive institutional exit can turn potential panic into actionable insight. The second hook is the importance of discernment. Not all crises are equal, and not every movement signals disaster. A 8 billion exit could reflect hedging strategies, liquidity needs, or forward-looking market predictions. Recognizing the context behind such moves allows an investor to differentiate between reactionary fear and genuine opportunity, positioning themselves to benefit from market corrections, fluctuations, and eventual rebounds. The third hook lies in the alignment of knowledge and action. When one understands why a major player is exiting, it becomes possible to anticipate the ripple effects, price shifts, trading momentum, and investor sentiment. Those who move with insight rather than impulse gain the advantage, turning potential volatility into strategic leverage. The fourth hook is adaptability. Markets do not wait for hesitation, they respond instantly to decisions by large institutions. Flexibility and readiness allow informed investors to navigate these waves, capitalizing on temporary dislocations and positioning for long-term gains. The fifth hook is the psychological edge. While many may be caught off guard or react emotionally, those who remain calm, analytical, and proactive can exploit the patterns created by mass behavior. Fear amplifies volatility, but insight tempers it, creating opportunities for those attuned to the underlying signals. The sixth hook is learning from history. Every market shift, every large exit, leaves a trail of lessons for those willing to observe, analyze, and internalize. A 8 billion silver exit is not just a singular event, it is part of a larger narrative about institutional strategy, market mechanics, and the delicate balance between supply, demand, and investor psychology. By interpreting these moments correctly, investors not only protect themselves from potential losses, but position themselves to capitalize on opportunities that others may overlook. In essence, crises like this transform the market into a proving ground, rewarding those who see beyond fear, act with strategy, and leverage insight into tangible advantage. The crisis in JPMorgan's Silver Vault is more than an isolated event. It is a powerful illustration of the critical importance of strategy, risk management, and foresight in financial markets. The first hook is this: the movement of 8 billion in silver is not just a number. It is a signal that demands attention from every investor, strategist, and financial analyst. Understanding these institutional moves provides insight into broader market mechanics that most casual observers overlook. The second hook lies in diversification. A single asset class, no matter how stable it appears, can shift suddenly, and exposure without strategic balance can magnify losses. Observing JPMorgan's actions reinforces the timeless lesson that portfolios must be resilient, adaptable, and prepared for sudden structural shifts. The third hook is anticipation. Large institutional adjustments are often precursors to broader market movements, reflecting liquidity pressures, risk assessments, or emerging opportunities. Those who study these signals can position themselves proactively, mitigating risk while capturing potential gains. The fourth hook is the lesson in attention to detail. Markets communicate through subtle movements, patterns, and timing, and those who ignore these signals do so at their peril. A 8 billion exit is not a headline, it is a story waiting to be decoded. A lesson in reading between the lines of institutional strategy. The fifth hook is the global perspective. In today's interconnected financial ecosystem, decisions made in one vault in New York can have cascading effects in London, Zurich, Hong Kong, and beyond. This interconnectedness magnifies both risk and opportunity, emphasizing the need for awareness of international market flows and institutional behavior across geographies. The sixth hook is discipline under pressure. Sudden shifts in large positions test the ability of investors and strategists to maintain objectivity, control emotion, and execute plans with precision. Those who master this balance can navigate volatility and capitalize on signals that others misinterpret or ignore. Finally, the crisis underscores a universal truth. Knowledge, insight, and foresight are among the most valuable currencies in finance. By paying attention to institutional movements like JPMorgan's silver exit, investors gain access to a rare vantage point that reveals hidden pressures, upcoming trends, and potential opportunities. Observing, analyzing, and understanding these shifts is not speculative, it is strategic. Those who learn to read the signals of major institutions position themselves not merely to survive market turbulence, but to thrive, leveraging insight into real advantage in a world where awareness and preparation define success. So, my friends, take this not as a fear-mongering tale, but as a wake-up call, a powerful reminder that in the world of finance, knowledge is your greatest ally and foresight is your most valuable currency. Watch the markets, study the signals, and understand the forces at play, because today's silver crisis could very well become tomorrow's historic opportunity. Stay informed, stay vigilant, and remember that those who anticipate change are the ones who thrive when others falter.